Hello everyone, welcome to another video for Principles of Accounts. Today here we have a question for depreciation and the sale of a non-current asset. So what we'll do is calculate the depreciation for multiple assets for different years, and then we will use these results to prepare the accumulated depreciation account. Lastly, we will calculate any profit or loss we have made on the sale or disposal of a non-current asset. As usual, you will see the workings on the right hand side of your screen, and on the left hand side of your screen, you will see the question. Okay, so with that being said, let's begin. Equip Trading bought two office equipment by check for $16,000 each on 1 August 2014. All right, so we're working with a business which purchased two assets, and each of these assets cost $16,000. So altogether, the business paid $32,000, and these assets were purchased on 1 August 2014. Moving on to the second paragraph, on 12 April 2017, one of the office equipment was sold for $13,000 cash. A new replacement machine costing $20,000 was purchased on the same date from Challenger Trading on credit. So we can understand that the first two assets which we had purchased, one of these assets have been sold on 12 April 2017, and we sold this asset for $30,000 cash. On that same day, we also bought a new asset, all right? So the last paragraph says that the company's policy is to provide a full year's depreciation at 15% per annum using the reducing balance method in the year of purchase and not charge any depreciation in the year of sale. The financial year ends on 30 June. So as you can see, the requirement of the first question is to prepare the accumulated depreciation account for the 3 years ended 30 June 2015, 2016, and 2017. Now I'm going to move to the right hand side of where I have the whiteboard with all the workings. So I need you to focus and concentrate thoroughly because we can have some complications in this question. All right? Okay. So we're working with a business where the financial year starts on 1 July and it ends on 30 June of the next year or the following year. Okay? So year one is starting from 1 August 2014 and ends on 30 June 2015. Now, why does it start from 1 August 2014? Based on the first paragraph, we know that the business purchased two assets on 1 August 2014, right? And we know that the financial year ends on 30 June, which means the first year will start on 1 August 2014 and end on 30 June 2015 of the following year, okay? So we understand that we have purchased two assets and each of these assets cost $16,000, which means altogether we would have paid $32,000, right? 16,000 multiplied by 2. Now, based on the company's policy, which is mentioned in the last paragraph of the question, we are to apply a full depreciation in the year of purchase, right? So if I want to find the full depreciation for one of these assets, right, in the first year, I'll just simply multiply the given percentage with the cost, okay? So under the reducing balance method, in the year one of usage, always multiply the given percentage with the cost. So we're multiplying 15%, which is given in the third paragraph. As you can see, I'm circling here, and that is multiplied with $16,000, which is the cost of one of these assets that we have purchased. So that gives us a full depreciation of $2,400 in the first year for one of these assets, right? So because we want to find the depreciation using the reducing balance method moving forward, which is from year 2 onwards, we want to know the net book value of these assets, all right? So the net book value should be calculated by finding the difference between the cost and the accumulated depreciation. So we're finding the net book value at 30 June 2015. So let me just make that note here. So net book value at 30 June 2015, which is simply the difference between the original cost and the accumulated depreciation. The original cost is $16,000 for one asset, and the accumulated depreciation is $2,400, which is the depreciation expense that we have so far in the first year of usage. That gives us a net book value of $13,600 at 30 June 2015, or at the end of year one, or at the end of the first year. Okay? And that's only for one asset. Now, we know altogether we have two assets, and each of these assets costs the same $16,000 to start with, which means in the first year, both of these assets should logically have the same depreciation and the same net book value. Make sense? All right. So the total depreciation for both of these assets combined is $2,400, which is the depreciation expense for one of these assets, plus an additional $2,400, which in this case we're multiplying by 2, and that gives us $4,800 as the total depreciation for two assets. Make sense? All right. Now, so I want to ask you a question. So what's the journal entry to record the total depreciation for office equipment that we have in the first year of usage, which is for the year ended 30 June 2015? How do we journalize this? So the way to journalize this would be to debit depreciation. So I'm just going to write DEPN in short. So depreciation of office equipment, all right, by 4,800, and then we would credit the accumulated depreciation account. So accumulated depreciation of office equipment. Again, I'm writing DEPN in short and equipment in short, but make sure in exam you write the full words, all right? Okay, so the journal entry to record the depreciation that we have incurred in the first year of usage is to debit the depreciation of office equipment by $4,800, which is the total for both of these assets, and to credit the accumulated depreciation of office equipment by $4,800. Now, I have a question for you. Which one of this is an expense? All right, so when we debit depreciation of office equipment by $4,800, our expenses are going up because depreciation in itself is an expense, which refers to the cost of an asset that we have consumed over its useful life. And when we are crediting accumulated depreciation of office equipment by $4,800, we are increasing an account which is known as a contra asset account. What is a contra asset account? A contra asset account is an account which records the reduction for a relevant non-current asset account. Okay, so the relevant non-current asset account in this case is the office equipment, right? Which is a non-current asset in itself. So any reduction that we want to record for this non-current asset, we put all those reduction, which is basically the depreciation, in an account which is known as the accumulated depreciation account. Okay, and that is what we refer to as a contra asset account, which records the reduction for a relevant non-current asset account, which in this case is the office equipment account. Okay. All right, so what was the purpose of looking into this journal entry? This may make it easier for you to understand how we can use these entries in the accumulated depreciation account. All right, so I've already prepared one in advance, so let me walk you through this. So to begin with, when we want to prepare similar accounts, you want to have 5 columns. The first column should have the date. The second column should have all the description or the narration for what we have done. The third column is the debit column with the $sign. The fourth column is the credit column with the $sign. And the fifth column is the balance column. Okay? All right. So the first year that just ended is 2015, 30 June, right? And in this year, we have a depreciation of office equipment, which we calculated to be $4,800. And you see that we are using this on the credit side. Why? Let's go to the journal entry. In the journal entry, we debited the depreciation of office equipment, but we credited the accumulated depreciation account, right? Okay. What account is this that we are preparing on the left-hand side? The accumulated depreciation account, right? So in the accumulated depreciation account itself, we have to show this 4,800 within the credit column. And this is based on the journal entry that we've just done a while ago, where we had to credit the accumulated depreciation, right? Okay, so hold that thought. So that is what we're including here within the credit column. And the narration here, or the description, is the depreciation of office equipment, okay? So the balance that we should have at the end of 30 June 2015 is 4,800, and it's a credit balance because, as you know, the only entry that we had was recorded on the credit side. So obviously, the balance at the end of the financial year should be on the credit side. So 4,800 credit, okay? Now moving on to the next financial year, which starts on 1 July 2016, we will carry this balance forward and we will call it the balance BD, or the balance brought down. And this is 4,800 credit based on what we ended the previous year with, okay? All right. Now these things, you can only get better with practice and practice. And we will be doing many questions where we will be practicing similar stuff every now and then, okay? So do not worry. Practice can easily make you get full marks for these questions in the exam. Okay, now let's look into the second year. So the second year would start on 1 July 2015, because the most recent year just ended on 30 June 2015, right? So the second year should start on 1 July 2015 and end on 30 June 2016, okay? And now, when you are in year 2, using the reducing balance method, you will apply the depreciation by calculating the percentage on the net book value. So the depreciation for one asset is calculated by multiplying the percentage on the net book value. So 15% multiplied on the net book value of 13,600, which we had at the end of year 1. So let me just scroll back up to let you recall. If you remember, as you can see here, net book value at 30 June 2015 for one asset was 13,600, and which is the same number that we are using here in year 2 to calculate our depreciation, okay? So that gives us a depreciation of $2,040, okay? And that's for one asset, as we understand. Both of these assets should have similar depreciation calculated because they were purchased for the same cost and they are being depreciated using the same reducing balance method and same percentage of 15. So the net book value for one asset now at the end of year 2 are at 30 June 2016, all right, is the previous net book value that we had, which is 13,600 minus the new depreciation of $2,040 that we had calculated for the current year ending 30 June 2016. Make sense? And that gives us a net book value at 30 June 2016 of 11,560. All right. Now, the depreciation for two assets is therefore 2,040, which is the depreciation for one asset that we had calculated earlier, plus an additional 2,040, which we, in this case, we're just multiplying by 2, and that gives us 4,080. Make sense? Okay. So let's look into the accumulated depreciation account. So you will see that for 30 June 2016, I'm including depreciation of office equipment as the narration, and the amount is 4,080, which is included on the credit side. Why is it on the credit side again? Do you remember the journal entry? What is the journal entry to record depreciation? Debit. Depreciation of office equipment. Debit depreciation. Let's just say debit depreciation expense by 4,080, and we would credit the accumulated depreciation, right, by 4,080. So you can see within the accumulated depreciation account, on the credit side, we have to include 4,080. So this is how a journal entry is transferred to the main account for accumulated depreciation. So 4,080 is included at 30 June 2016 within the credit column. Okay. Now we don't have anything else. And now these numbers get added up together for everything we've got on the credit side, which is 4,800 from previous year, plus an additional 4,080 for 30 June 2016, which makes it 8880 or 8,880, and it's a credit balance because we don't have any debits yet. So that's the opening balance that we have at 1 July 2016. Right? Okay, so 1 July 2016, balance brought down 8,880 credit. All right. So let's move to the last year, which is year 3. So year 3 starts on 1 July 2016 and ends on 30 June 2017, which is the last year in this question that we're concerned. And we know a lot of things happened in this year. Firstly, we sold one of the assets that we had originally purchased. All right. So one of the assets was sold. Okay. And that asset which we had sold will have no depreciation in the year of sale. I'm just going to connect my charger because the iPad is going to run out of charge. All right. Okay. So in the third year, we know that we had sold one asset, and based on the company policy, no depreciation is to be charged in the year of sale. Okay? All right. Now, what we want to do first is depreciate the asset that is left. Okay? So, how do we depreciate the asset that is left when we are using the reducing balance method? You guessed that right. It's just to apply the percentage on the net book value that we had at the end of year 2. Right? The percentage is 15%, as we already know, based on the third paragraph of the question. And the net book value that we had derived at end of year 2 was 11,560, right? So let's just cross-check that again here. Net book value at 30 June 2016 is 11,560, okay? All right. So depreciation for this other asset that is left is simply applying the given percentage of 15 with the net book value of 11,560, which gives us $1,734. Right? Okay. Now, also remember that we had purchased a new asset, haven't we? Yes. So the new asset that we had purchased is to go through a full depreciation based on the company policy, right? So the full depreciation for this new asset is simply applied by multiplying 15%, the given percentage, with $20,000, which is the original cost of this new asset that we have purchased. And where did I get this number from? You'll see I'm just about to highlight on the left-hand side, 20,000. Do you see that? I'm just circling it. All right. Okay, so full depreciation for this new asset that we have purchased is 15% multiplied by $20,000, which is $3,000. All right. So altogether, the total depreciation expense for the year ended 30 June 2017 is 1734, which is for one of the assets that was left behind, plus an additional $3,000, which is for the new asset that we had purchased, altogether giving us $4,734. Make sense? Okay, so how should we record this in the accumulated depreciation account? Let's have a look. So, 2017, on April 12, we had disposed an asset. We're getting to that, just bear with me. But for the year ended 30 June 2017, we've got a depreciation of 4,734, and this is recorded on the credit side. And you understand why is this recorded on the credit column here, based on our discussion of how a journal entry translates into the main account. Okay, so that's 4,734 is what we just calculated a while ago. Now, what about this number in red? Sale of asset 4440 on April 12, and that's on the debit side. What does that mean? All right, so let's have a look. Okay, so one of the assets was sold, we understand. And the net book value for this asset that we had sold was 11,560. Which net book value is this? This is the net book value from 30 June 2016, which is the end of year 2. Okay. So at end of year 2, the net book value was 11,560. This asset had no depreciation charged in the next year, which is year 3, which started on 1 July 2016 and ended on 30 June 2017. No depreciation was charged. So the only net book value that we can be concerned of is the one that we had derived originally at 30 June 2016 or at the end of year 2, which was 11,560. And this net book value of 11,560 represents the economic value that was still left for consumption or for usage for the purpose of generating revenue in your business. All right? Now, do you remember that we had purchased this asset for $16,000 based on the first line of the question, where we bought 2 assets, each at $16,000, right? Each. Okay. So if the cost of one of these assets was $16,000 and the value that was left after 2 years of usage was $11,560, how much did we have in total depreciation or accumulated depreciation? It's just simply the difference between the original cost and the net book value, which is 16,000 minus 11,560, and that's $4,440. Okay? So this $4,440 is what we are including here. As you can see, for the year 2017, on April 12th, the description of the narration is sale of asset, which is the cross-reference with the other account. And this is on the debit side. Why do you think this is on the debit column of the accumulated depreciation account? Every time we record something within the credit column of the accumulated depreciation account, it means that depreciation is increasing. But in this case, we are getting rid of one of the assets. We are selling one of the assets. We are disposing one of the assets. So if we're getting rid of one of the assets, then we also have to remove the accumulated depreciation for that particular asset from this account. And when we remove that, our accumulated depreciation should go down, right? And that reduction can be only reflected by recording it within the debit column. Make sense? So that is why this 4440, which is basically showing the disposal or the sale of the asset, is recorded within the debit column to reflect the fact that we're getting rid of this asset and this number doesn't belong in the books anymore. All right? Okay. So at 30 June, we have the total depreciation for 2 assets, one old asset and one new asset, altogether being 4,734, which is within the credit column because this is increasing the accumulated depreciation as we understand. So what's the final balance that we have got at 1 July 2017, or our opening balance, which is also known as the balance bidding? It's 9,174 credit. How do we get that? Okay. So we start with 8,880 credit, which we had at in the previous year at 1 July 2016. Then we subtract 4440 from 8,880, right? And then we add 4,734. So 8,880 minus 444 plus 4,734, which gives us 9,174. Okay, and that is being shown on the credit side because by default the accumulated depreciation is a credit account, which means it should always have an opening balance on the credit side, and this is a contra asset account which records the reduction for a relevant non-current asset account. Okay, all right. Now what's the next question? Calculate the profit or loss on the sale of non-current asset. Okay. Now, this is fairly easy. So the disposal proceeds, which refers to the amount that we had sold this asset for, was $30,000 cash, which is the first line of the second paragraph. Okay. And the net book value for this asset that we had sold was $11,560. Net book value at any given point in time is the difference between the cost and the accumulated depreciation. Net book value stands for the economic benefit still available for consumption, which also means the how you can utilize this asset within your business to help you generate more revenue. So it's an asset, obviously, with some value remaining. So the value that was remaining is 11,560, and you ended up selling it for 13,000. Okay, which means you ended up selling it for more than what it was worth at that point in time, isn't it? Yep. So in that case, you've obviously made a profit, and the profit on the sale of this asset or the profit on disposal is just simply the difference between 13,000 minus 11,560, and that's $1,440. Okay, so that's it for question B. Right, so that's all for today's lesson. Make sure to comment all the videos that you need me to make, and also like and subscribe to this channel, and I'll see you in the next video.